What did it say?
In terms of the grading policy on quizzes, the average the lowest quiz against the other quizzes or the skeleton quizzes and the exam.
And the exam. Otherwise, you'll have too much gaming because you do really well in the first two quizzes. There's no point taking the third quiz, right?
Well, I was saying you only get that policy if you click with it.
No, but if you miss one of the quizzes, I said this, that now you lose the average. But if you took all three quizzes and I average just across the quizzes, you did, let's say you got perfect scores in the first two quizzes. You just take the third quiz and just now you don't care. I want to make sure that you always care about the quiz you take because there is some residual effect of what will I do on the final. Okay, folks. I hope you've had a chance to pick up your quizzes. If not, they are still in alphabetical order. When I left, come down. I hope they're still in alphabetical order when I go up. Okay. So please leave them in alphabetical order. Otherwise, I know I'll have to resort them. And tomorrow I'm leaving for San Diego, so I won't even be able to resort them if you screwed up over the weekend. But they will stay out probably for 10 days. Let me take the probably out. They will stay out for 10 days. You know what happens in 10 days? There'll be a third quiz. In which case I have to take the second. I can't throw them out legally for a year after you take this class. You know that? NYU doesn't allow you to. But I actually throw them out the day after the class is done. What are they going to do? Fire me? Or whatever they decide to do. But if you don't want your quiz, I don't want it either. So I will hold on to it till the end of the class. But I think it is a good idea for you to at least pick up your second quiz. There are about 100 unclaimed first quizzes. 100. 1 out of 3 people thinks that if you don't see something, it doesn't exist. But it does, right? So might as well pick it up, even if it's bad news, and get it out of the way. I thought that this was a easy quiz because you know why? Because after last Thursday and Friday, I thought you needed a break. But now that the market is up, I think I'll up my ante for the third quiz and hit you with a really difficult one because you'd be. So let's start this class. Talk about pricing. You have the ammunition now to be able to do pricing. So let's see if the last few sessions have kind of stuck. I told you I was in Latin America last week. I was in Chile and then I was in Argentina. Let me reframe this question using Chile and Argentina as my examples. Let's suppose I look at the PE ratio for Chile and the PE ratio for Argentina. PE ratio for Argentina is much lower than the PE ratio for Chile. It makes Argentine stocks cheap, right? But what else explains why Argentina has a lower PE ratio than Chile? In Latin America, Chile has always been the outlier, the safest country in a continent full of very risky countries. Okay? So Chile is safer than Argentina. Other things remaining equal, what does that mean? Less risk should push up your PE ratio. So Venezuela and Argentina will have the lowest PE ratios. I think, Venezuela trades at 6 times earnings, 5 times earnings. Argentina trades at 7 times earnings, but part of that is risk. And to the extent that the risk goes away, PE ratios should rise. Let's try a second one. It's an extension of what we did a couple of sessions ago when I looked at the earnings to price ratio for the S&P 500. Okay. P ratio right now, even, I was going to say, even if you count what happened last week, or because if you look at what happened this afternoon, we might be back to where we were before last week. So God only knows where we are. But the P ratio has been higher for the S&P 500 for the last few years. So let me list out. It might mean that stocks are overpriced, but let me list out possible explanations that are not, that have nothing to do with it being overpriced. No, especially in 2019, 20, 21, when you saw PE ratios at highs, risk-free rates were at historic lows. Can that explain why PE ratios should be higher? Lower interest rates, higher PE ratios. So for a decade, we had higher PE ratios, and you could say it's a risk-free rate. That's no longer the case anymore, right? Could it be that the equity risk premium is much higher than it has been historically? Equity risk premiums get higher, the index should actually go in the other direction, right? Equity risk premiums being lower can explain it, but not higher. Could it be the return equity has increased over time? Does that play into your PE ratio? Higher return equity should push up PE ratio, so that could be a good reason. Could it be that the expected growth rate is going to be higher in earnings in the future? I'm not saying any of these explain it away, but when you look at the PE ratio for the market, you have to control for interest rates, you have to control for return equity, you have to control for risk premiums, and you have to control for what the growth is before you decide stocks are overpriced or underpriced. And my final question is about PEG ratios, and PEG ratios basically, and what you're assuming when you use PEG ratios. So let's say company A has a PE ratio of 20 and an expected growth rate of 10% a year. Company B has a PE ratio of 10 and an expected growth rate of 5% a year for the next month. If I compute PEG ratios for these two companies, I'll get exactly the same PEG ratio, 2 for each company, right? 20 divided by 10, 10 divided by 5. So I could conclude that company AB is cheaper because it has the lower P. Company A is cheaper because of higher expected growth. Or if I believe PEG ratios, that they're both correctly priced or priced similarly. But is that true though? That the PEG ratio is the same? The two stocks are priced correct?
Because
And which means as your growth doubles, your P might not double. Problem with PEG ratios, that's a linear assumptions about growth. We talked about how as PEG ratio, as growth changes, the PE ratio can change disproportionately. So what we're going to do today is go through a series of other pricing multiples. And by now you know the script. I'm going to go back to an intrinsic value model. And I'm going to use the intrinsic value model to try to address what are the variables that drive a multiple, and then use that to ask what questions about a company being cheap or expensive. So I left you the EV to EBITDA multiples, and I said EV to EBITDA multiples basically are determined by a bunch of variables. And here are the variables: the cost of capital, growth, and reinvestment rate, which you should see in any enterprise value multiple, and the tax rate. Why does tax rate matter when you look at EV to EBITDA multiples? Because EBITDA is before taxes. And I ask you to think about a hypothetical where, what if you're looking at a country where the tax rate is 100%? An absurd example, but let's say you have a country where they take all your earnings away. What multiple of EBITDA should you pay in that country? Should be zero, right? You're going to get nothing anyway. So when you look at EBITDA multiples, you always have to ask about tax rate. So I'm going to go back and set up a hypothetical example where here's what I have. I have a company with a tax rate of 36%. CapEx is 30% of EBITDA. Depreciation is 20% of EBITDA. So the net CapEx is 10% of EBITDA. So that's what they're reinvesting. Their cost of capital is 10%. Let's ignore working capital requirements to keep things simple. I'm going to compute the EV to EBITDA multiple, a fair intrinsic EV to EBITDA multiple, assuming the company is in stable growth, growing 5% a year. So all I've done is plugged in the numbers: tax rate of 36%, 10% cost of capital, 5% growth rate. And what I get as my intrinsic EV to EBITDA for this company is 8.24 times EBITDA. Given those numbers, I would expect this company to trade at 8. As I said, if all you do is this equation is kind of pointless, you'd have got the same value with the discounted cash flow model. But the nice thing about these hypothetical examples is I can change one variable at a time, which you can't do in the real world, right? Because everything in a company is connected. So the first thing I did was I changed the tax rate from 36 to 30 to 20 to 10 to 0%. Or also increasing it to 50%. No surprise here, as my tax rate goes from 0 to 50%, the EV to EBITDA multiple, a fair number to pay, goes from 14 times EBITDA to less than 6 times EBITDA. Same company, same numbers, different. Saying, when would I ever get tax rates that different? Let's say you're the airline analyst for Europe. And within your sector, you have all of the airlines of Europe, including Ryanair, the Irish airline, and Lufthansa, which is the German airline. Given that graph, if you're not aware of it, which of these companies is going to look cheap and which one's going to look expensive? You're looking for low EV to EBITDA. You're going to find low EV to EBITDA. Which company is going to have the low EV to EBITDA? Sorry? Try again. 50. So, because if you have a high tax rate level, so you're going to end up with the airlines and countries with high tax rates look cheap because they'll trade low. Ryanair is going to look expensive, and you say that's a really expensive airline until you factor in that the Irish tax rate is only 12%. So if you're comparing across countries, companies across countries with different tax rates, same thing is true in Southeast Asia. You have Indonesian companies, Thai companies, basically, all competing for the same investor base. You got to control for differences in tax rates. Yes. I'll tell you something about pricing. There is no right, there's no better or worse as long as you control for differences. I have no problem with you using EB to EBITDA, and as long controlling for differences in tax rates is pretty trivial to do, right? But you do have to remember to do it. With price earnings ratio, it's true you don't have to control for difference in tax rates, but you invite other problems, right? These are companies in different countries. They have accounting standards that vary. Earnings per share is going to be much more affected by those choices than something further up the income statement. Let's talk finally about revenue multiples. Remind me again why we use revenue multiples. First is desperation, right? This is the only number that's positive. What else is good about revenues? We've been complaining about accounting all this time, right? What's the number the accountants have the least influence over? It's revenues. Anytime, the further down the income statement you go, the more you worry about accounting effects. Earnings per share is the worst. Even revenues, you still have some mild discretionary choices, especially when you have revenues over multiple years. But so revenue multiples are here to stay. Let's see what drives the revenue multiple. There are two variants that you would see of the revenue multiple. Price to sales, where you take market cap and divide by revenues, which we already said is an inconsistent multiple because numerator is an equity value, or the more consistent version, which is enterprise value to sales. The biggest selling point is you can compute them for pretty much every company if your business has revenues. What kinds of businesses don't have revenues? Well, but let's go even on the established companies. There's a whole bunch of, in fact, a very big sector where you will not see a revenue line item. Yes. Sorry? Biotech eventually have revenues, right? Amgen has revenues. So that's again, young companies might not, but this is even mature companies and businesses. Try banks. You know what? You look for a revenue item, banks has no such thing. There'll be interest income minus interest expense. Financial service companies don't have revenues. That's why when you look at my industry averages, I don't report industry averages for investment banks, commercial banks. It's not like they don't make money, but there's nothing to scale it to in terms of revenues. But if your business has revenues, which is the rest of the market, you can compute revenue multiples. You're not going to lose companies which are money losing, so you get the entire sample. So before I show you the page that tells you what the drivers of revenue multiples are, I want somebody to guess. Every multiple has a companion variable. You know what I mean by a companion variable? It's a one number you'd like to know before you use that multiple. I'll give you a preview. With price earnings ratio, when I tell you a stock has a low PE, the one question you should ask is what kind of growth rate does it have? Most of the time when you have a low PE, it's going to go with a low growth rate. So you're looking for, is that the reason? With price to book, what do you think the companion variable is? What's the one number you'd like to know? The return on equity, right? Most low price to book stocks have low returns on equity. With revenue multiples, what's that one question? So let's say I'm a broker and say this company is trading at 1/4 revenues. What would you like to know? You're close, but there's something even more direct that will usually tell you why the company is trading at a low multiple of revenues. It's exactly right, right? If you have low margins, you will trade at a low multiple of revenues. Okay. But revenue multiples, a key driver is profit margins. What kinds of businesses have low margins? First is bad companies have low margins, but there are some really good companies with low margins as well. Who's doing Costco? Somebody in the class. I think at least 2 people are doing Costco. Trust me, I'm not going to ask you a deep question. No, nobody's doing Costco? Okay. But you're familiar with Costco, right? Been a success story in brick and mortar retail. A very unusual success story because the rest of brick and mortar retail is kind of melted down. So we can talk about what's allowed Costco to not just survive, but prosper. But it had trades at a low multiple of revenues. In fact, if you rank it across companies, it's actually below the median for typical retailers. Why is that? What's a Costco model? At low prices. They're a low margin, high turnover company. Walmart is the same way. It doesn't mean they're bad companies. It means that they'll trade at low multiples of revenues, but they hope to get really, really, really high revenues. So low multiple of a really high revenue is better than a high multiple of very little in revenues. I'm going to give you a simple way in which you can always get the companion variable. If I give you a multiple, all you need to do is take earnings and divide it by the denominator of your multiple, and you'll get the companion variable. The earnings you use will depend on whether I'm an equity multiple or you have no idea what I'm talking about, right? Let's try this. Price to book ratio. What is it, an equity multiple or enterprise value multiple? An equity multiple, right? So what's the earnings that goes with equity? Net income. You divide net income by book value of equity, what do you get? Return equity. If I'd use one of those misguided people use price to sales, what's the companion variable going to be? What's take net income, divide by sales, and what do you get when you divide net income by sales? Net margin. You're saying it doesn't work with price earnings ratio. If I take price earnings ratio, saying dividing net income by net income gives me 1, but net income in the future divided by net income today is expected growth in net income, works with PE as well. You ready to try this with enterprise value multiples? Enterprise value to invested capital. Let's try it out. What's the measure of earnings that goes with enterprise value? EBIT. So, and what's EBIT divided by invested capital? It's return on capital, EV to investment. EV to sales. I'm going to stay with you. EBIT divided by sales is operating margin. It's like magical, right? You take whatever multiple, you take the measure of earnings that goes with it, divide by the denominator. So try it out on some foreign multiple. It's amazing how you can get that one question you want answered before. So let's prove this algebraically. Again, don't get thrown off by the number of terms of the equation. This is a two-stage enterprise value model. I've computed it in terms of EV to sales by dividing both sides by sales. And there's the magic, after-tax operating margin. High margin companies will trade at high multiples of revenues. Low margin companies will trade at low multiples of revenues. It's no reflection. Unlike other multiples, when you think about low numbers as a bad thing, the company, with revenue multiples, you got to be very careful because they capture only one half of the equation. So EV to sales is driven by reinvestment rate, cost of capital, growth rate. Those are always the constant. After-tax operating margin is that companion variable. So if you can make a table of 6 or 7 or 8 commonly used multiples, come up with that companion variable and those other variables, because those are the questions you need to ask to answer, is that a cheap stock, or is that a stock that just deserves to be cheap? How many of you are I don't even know how majors work in the undergraduate business school. Can you be a marketing major? Yeah? Are there any marketing majors in this room? Nobody's misguided enough to do that. But in marketing, of course, brand name is a big deal, right? And in marketing, Welcome. I'm sorry, I forgot to enter your names in the visitors list, but you managed to get into the building anyway, right? We have some high school visitors, so be nice to them. So if you think about the value of brand name early on, what did I say about brand name? What does brand name give you? It gives you pricing power, right? Not just resilience, which is stability, higher margins. So I'm going to use that to capture the value of a brand name using EV to sales rate. EV to sales rates, we said, are driven by brand name. Maybe looking at revenue multiples for companies is going to tell me which companies have more valuable brand names. So if my hypothesis is right, what should you expect to see? Brand name companies should trade at much higher multiples of revenues than no margin companies because of the difference in brand name. I know it sounds abstract, but let me use an actual example. About 20 years ago, I got a call from a student of mine who's pretty high up in Coca-Cola management team. And he said, and Coca-Cola is a company that's obsessed with brand name. For a long time, it was the most valuable brand name in the world before the advent of technology companies. So he calls me and said, can you come to Atlanta and talk to our top management team about brand name? They're obsessed about how much it's worth. So I said, okay, moment of weakness. Because New York to Atlanta is this incredibly expensive flight. I don't know why. They just, you know, I guess it's a captive market for, I don't know, Delta or whoever flies there. Show up in Atlanta, show up at Coca-Cola headquarters. I carried a can of Pepsi in with me. Sometimes it's good to keep people off balance. So they had the top management team gathered together and said, you know, and I went through an intrinsic valuation of Coca-Cola, the traditional intrinsic valuation, free cash flow, the cost of capital, return on capital. The value that I got for Coca-Cola based on a traditional intrinsic value was about $80 billion, 79.6 billion. So I finished my valuation expecting applause. This guy in the front row puts up his hand. So you forgot something very important. Said, what, a beverage, a geography, what? So I said, what did I forget? He said, you forgot the fact that Coca-Cola is the most valuable brand name in the world. I said, so? He said, you should be adding a premium to that 80 billion. I said, how much of a premium? He said, at least 20%. I said, why? He said, because that's what we do at Coca-Cola is when we buy brand name companies, we value them and then we add 20%. I said, just because you do stupid things doesn't mean I have to do stupid things as well. He said, don't you think our brand name is value? I said, probably the only thing in this building of any value. What else is in that building? You know, the syrup, who cares? The management team, ChatGPT could run Coca-Cola, probably better than existing management can. I didn't say that there because there was no ChatGPT. That's what I was thinking. He said, why aren't you adding a premium? You know what my answer was? It's already in there. He said, where? I said, why do you think you have 15.57% margins? Do you think it's the taste? Do you think it's a red can? It's because you have a brand name. Why do you think returns on capital are 21%? Because you have a brand name. Even your cost of debt, you walk into a bank in Atlanta and say, we're Coca-Cola. Do you think your cost of debt is affected? Absolutely. Every number in your valuation already reflects your brand name. He said, I don't believe you. This is what happens when you argue with marketing people. But I came prepared. And I got lucky. I found a company called COTT, COTT. It's a Canadian company that sells almost as many cans of soda as Coca-Cola does in the US. You never heard of it, right? You know why? Because they allow supermarkets to put their own brand names. They allow you to put a generic brand name on there. They're a generic soda company. So here's the question asked. If tomorrow we all woke up with selective amnesia, and the only things we didn't recognize were the words Coca-Cola and that red can, what would happen? In other words, I would say, what if I turned off the brand name? How much you'd become a generic soda company, right? And if you're a generic soda company, you're going to have generic soda company margins, 5.28%. You have generic soda company margins, you have generic soda company returns on capital, 7%. It ripples through all the way. It affects your return on capital, your growth rate, and it translates to a value of 15.4 billion. You want me to give you a brand name premium? I just did. In fact, you take the difference in those two numbers, I'm giving you $64.4 billion. 80% of your value as a company is coming from your brand name. You don't think it's enough? Tell me why. But your value is already in there. You see why this works well for Coca-Cola, but might not work well for an Apple? What is it about Coca-Cola that makes brand names so easy to isolate? Yes. In fact, it's the only competitive advantage here, right? As contrast with Apple, Apple has some brand name. What else goes into an Apple premium? The operating system is different. There's a styling effect that John and I put in there. But the more competitive advantages you have, the more difficult it becomes to separate them out, right? We tried with Birkenstock, but that's because I made those artificial lines. When you have a single competitive advantage, it's easy to say this is where it comes from and value the competitive advantage, and that's what we've done here. So when you look at revenue multiples across companies, one simple way to see if your company is a brand name company is to see if it trades at a premium above the typical revenue multiple for that sector. So I won't punish you anymore by taking you through any more multiples, but by now you see the script, right? If you have an equity multiple, go back to the simplest equity valuation model, a dividend discount model. With the algebra, you can tell me what drives the price earnings ratio, price to book, price peg ratio, price to sales. At least you're getting a sense of what drives that multiple. If you have an enterprise value multiple, go back to the simplest enterprise value model you can think of. And with the algebra, you can tell me what drives pretty much any multiple. Free cash flow to the firm multiple, EBITDA multiple, EBIT multiple, revenue multiple. Why we're doing it? Because the essence of pricing is to know what to control for, what questions to ask. And this will give you a way of determining what those variables should be. I wanted to take a multiple like enterprise value to subscriber. If I took Netflix, Spotify, Disney Plus, Disney Plus is tougher because Disney is part of a company. But let's say Netflix versus Spotify. You take the enterprise value of the company, divide by the number of subscribers each one has. I haven't even looked at the numbers, but you'll get different numbers. What are the questions you would ask if you're looking at enterprise value to subscriber? Any questions you might have? Let's say Netflix has a higher multiple value per subscriber.
I want to understand what exactly drives those subscribers.
The value of a subscriber, right? So let's boil down on that. What is it that drives the value of a subscriber?
Look at a Netflix, the fact that they're sticky and the fact that you don't.
Before we do that, first we start with what do you charge, right? So you're looking to see what does Netflix charge, what does Spotify charge, and if Netflix charge a lot more per month, that's a starting point. I have both. I don't even listen to Spotify, but my family does. I pay roughly the same, so it's not the level. What else? So basically, that's going to come in, and whether that content scales up with the number of subscribers, if you have economies of scale. Okay. Let's stay on a subscriber, though. We know how Netflix makes money. It makes it per subscriber. It's the acquisition cost of your growing growth. How much growth is there? We're asking the right questions, and that's what pricing should be about. And don't forget one final question. What's your churn rate? You know what a churn rate is, a subscription model? It's what percentage of your subscribers do you lose every year? Businesses with high churn rates should have much lower value per subscriber than business with low churn rates. That's essentially what pricing is all about, is asking the right questions. I mean, I've seen people more often than not in the last decade, and they conclude that Tesla is overvalued. Lots of good reason to conclude that that's the case. But the way they do it is they take the enterprise value for Tesla, divide by the number of cars sold. And they compare it to the enterprise value to cars sold for GM or Chrysler or Volkswagen or Toyota. And guess when which one always looks cheaper? All the legacy auto companies all look cheap relative to Tesla, which is, neither here nor there. It could be because Tesla is overvalued, but it could also be there's no growth in a legacy company. In fact, you might be looking at shrinking businesses with shrinking margins. We have to ask the right questions before use of pricing to make that judgment. So define, describe, analyze. Let's get to the apply stage. For those of you who sent me your DCFs, I'm still working. I've like 123 left, and I'm going to try to get them out today and tomorrow. Okay. But if you got your DCF back and it looks pretty close to done, and many of you it was pretty close to done, you got to check, right? 2/3 of your project is done. There's one more agenda item that you really have to complete, which is you have to price your company. What does that involve? You got to find first a peer group, and you have to pick a multiple, and then you got to compare across these companies. But a big part of that is finding a peer group. So I want to talk a little bit about how do we come up with that peer group? What are the companies that you want to put into that peer group? I mean, in theory, you'd like companies just like yours, right? Similar cash flow, similar growth, similar risk. It doesn't even have to be in the same business, but you're looking for companies similar to yours. And then even after you get those companies, you got to kind of find a way to control for differences across those companies. So let's take that first part. How do you find a peer group? And I'll give you the fundamental choice you face. And I will let you kind of work out which of those pathways you're going to take. When you look for a peer group for your company, you can look for companies just like your company. Very simple in terms of size, in terms of geography, in terms of what you do. And end up with a smaller sample of companies just like yours. It might have only 2 or 3 companies if you're lucky. Or you can define companies more broadly and bring in a much larger sample of companies, but with big differences in growth and risk and cash flows. Which is better? Find companies just like yours, small sample. Of course, you say, I'd like a large sample of companies just like mine, but that's not going to often be the case if you can do that. Yeah.
Find a middle ground. You set some limits on how different growth and all these other fundamentals can be, and then you look at companies in that range.
Okay. But before you do a middle ground, do you also need to decide how you're going to use those companies? Because once you get that peer group, there are different ways and you can do this analysis, right? One is you could try to do direct comparisons. You want to do a direct comparison, you want the companies to be very, very similar. Through much of the 20th century, equity research analysts in the US who followed the auto sector, you know how many companies they tracked? 3 companies, GM, Ford, and Chrysler. Didn't even bring in foreign companies, GM, Ford, and Chrysler. And in fact, of those 3, GM and Ford were often the only 2 that they compared. They compared GM to Ford. They said GM looks cheap relative to Ford, or Ford looks cheap relative to GM. It's a direct comparison. You want the companies to be very, very similar when you do that. If you have 4 or 5 or 6 companies, you might not be doing a direct comparison, but you might be comparing the companies and then telling a story and hoping the story kind of captures the difference. You might say, look, I'm comparing 5 companies. My company has a higher multiple of earnings than these other companies, but it's higher growth, so it's okay. So again, you still want companies just like yours on every other dimension. If your plan in pricing is to just tell stories or do direct comparisons, you want your sample size to be small and look just like your company. So if you're valuing Bajaj Auto, an Indian automobile company, you know who you're going to look at? Other Indian automobile companies. There aren't that many, but you're hoping they're all Indian, they're all automobile companies, they sell into the same market. And you probably don't want to include Tata Motors in the mix. Why? Because you have the Jaguar Land Rover thing in the side. So you're going to try to make things, because you want to keep those comparisons simple. But I'm going to open the door to a different way of controlling for multiples. One is you try to take the companion variable and you try to bring it into the multiple. That's what PEG ratio is trying to do, right? Price earnings, the big companion. It's a dangerous game to play because of that linearity assumption, but I'm going to suggest a different way of controlling for multiples that falls back on your statistics. Remember the multiple regression we ran across when you looked at P ratios across countries? You're going to see me use that repeatedly in the next few examples to try to control for differences. Because that's what multiple regressions were designed to do. Bring in the variables you're worried about and control for those differences. So you can relax now because I'm going to play the role of a naive equity research analyst. I'm going to put buy recommendations and I want you to shoot them down. You have the ammunition now to shoot them down. Ready? So here's my first try. I am the beverage analyst and this is my sector. And I'm going to put buy recommendations in 3 companies in this sector. Andre Wine, you know what they make? Champagne that's so cheap that watching a commercial for it, I think, can give you a headache. Okay? Usually see it only around Christmas time. Todd Hunter, I have no idea what they make. Probably cheap liquor. And Hanson, my 3 buys. I told you I was a naive analyst. Why did I pick those 3? Sophia, what is it that those 3 companies share? All have P ratios less than 10. I picked the 3 companies with the lowest P ratio. I'm lazy. Not only am I naive, I'm lazy. I picked the. So you can now poke holes in it. So what's with Andre Wine and Todd Hunter? What is the reason they trade, Samita? Really low growth, so they trade. Hanson looks interesting, right? It has high growth, but it's a highest risk company, right? This is the problem with storytelling. They look cheap, but there's a really good reason they're cheap. With Andre Wine and Todd Hunter, the reason is really low growth. And with Hanson, it's really high risk. Not much place to go, right? And this is the problem with storytelling and pricing, is if you have an agenda, you're going to find a way to spin the story and say it's okay, or you can make these companies cheap, expensive, whatever you want them to do. So I got fired as the beverage analyst because of the sloppy job I did. I land on my feet. I'm now the telecom analyst in the late 90s. I can also move in a time machine across time. That's the way I get rehired. And to give you a sense of the telecom business, before the 1990s, publicly traded telecom companies were almost entirely in the US. You know why? Because outside the US, the telecom businesses were owned by governments across much of the world. That started to change in the 1980s. You started to see them privatized. They became publicly traded companies. So this is the 1990s, and I've looked at telecom companies, and I'm looking at ADRs. You know what ADRs are? Foreign companies listed in the US. The advantage of looking at PE ratios based on ADRs is, at least in theory, all your earnings were required to be restated using GAAP numbers. So the earnings should be comparable. So here again, I'm going to play the role of a naive analyst. I have only one tool in my arsenal, which is what? I can compare PE ratios. I'm really good at that. I can find low numbers and high numbers. Incredible skill. And I come back with 2 buy recommendations, Telebras and Indosat. For those of you who've never heard the company names, Telebras in the late 90s was the monopoly telecom company for Brazil. It's since been broken up into 7 telecom companies. So it's a Brazilian telecom company. Indosat in the late 90s was the Indonesian telecom company. And Indonesia in the late 90s was a very risky country to be in because 96 had a complete meltdown. I'm laying the foundation for you to poke holes. So these stocks could be cheap, but Yara, what else could explain why they trade a low PE ratio? High risk. They're in risky emerging, because if you look at that list, some are emerging market telecom companies and some are developed market, the German and the Danish telecom company in there. So one could be high risk. Sophia, what's the other? They have relatively low growth. This time I'm not going to tell stories because I'm going to spin myself into a corner. So I open up my statistics book to the multiple regression chapter. What am I trying to explain? Differences in PE ratios across these companies. So that becomes my dependent variable. What are the 2 things that worry me? Growth. So I put in the growth rate. And the other is risk. And I'm going to use a very generic proxy for risk. You know what a dummy variable is in statistics? Takes on a value 1 or 0. You do it to capture something that splits the sample. So dummy variable of New York City baseball fans will be Yankee fans, Mets fans, 0, 1. I'll put the Mets fans as zeros and the Yankee fans as ones because that's my prior bias, but just to separate the 2. So here I created a dummy variable where if you're a developed market telecom company, I put in a 0. And if you're an emerging market telecom company, I put a 1. And then I ran the regression. The R squared that I got was 66%. Remember last session what I said about R squared? 66% is a pretty good R squared. I'm okay with that. Let's see if the variables have the right signs. Every 1% increase in growth increases my PE ratio by 1.21. So if you're a telecom company with a growth rate 5% higher than mine, your PE ratio should be roughly 6, 5 times 1.21 higher than mine. But if you're an emerging market telecom company, so let's say I have two telecom companies, they have the exact same growth rate. The emerging market telecom company will have a PE ratio 13.85 lower than the developed market telecom company. Remember when we did discounted cash flow valuation, the way we penalized risky countries is we pushed up their cost of capital. This is the market's way of doing it. It does it through the multiple. As for the intercept, all it tells you is the level of the multiple in that sector. It's the starting point. The final check, you check for the T statistics. We talked about the tip-off point above 2. They're all statistically significant. I'm ready to launch. I can take this regression and remember the two companies, Indosat and Telebras. Let's take Telebras and plug in Telebras's growth rate and the fact that it's an emerging market company, the regression. I get a predicted PE for Telebras of 8.35. How would I describe that? If you're trying to explain this to a non-statistics person, the way you'd explain it is, given how telecom companies are priced, and given Telebras's low growth and high risk, this is what the PE ratio should be. It's a conditional pricing. It's actually trading at 8.9 times earnings. It is actually overvalued, not undervalued. Even though its PE ratio looks low, after you control for the low growth and the high risk, it becomes overvalued. The advantage of statistics is it allows you to break through the storytelling, say, okay, you have lower growth, it's okay, you have higher risk. How does that play out as a predicted value? Any questions on that example? So basically, I'm just looking across the sample. The one thing though is if you have a sample size of 4 or 5, remember that small sample you chose, you can't do this. You cannot use statistics unless you get your sample to enough of a size for you to be able to run regressions. My usual rule is you need a sample size of at least 10 to have one independent variable. You need a sample size of at least 20 to get to 2 independent variables. You're saying why 10? Could be 12 and 24, but you need enough numbers in there. If you take a sample size of 12, for God's sakes, don't throw 4 independent variables in there. It'll break your statistics package down. Your regression will start to give you nonsense. So the advantage of larger sample size, you can control for more things. So I get fired as the telecom analyst. I move forward in time. I'm now the European banking analyst. I'm very, so, then now I've learned a new pricing multiple. The PE didn't work for me in my last 2 jobs. I got fired. Now I'm going to use price to book. And with banks, actually, price to book ratios have heft. Book value for equity at a bank has more meaning than book value for equity at pretty much any other company. Why is that? Why is book value for equity for a bank more meaningful? One is book value of equity is a number you can't mess with because it drives it. What else? But what goes into the book value of equity for a bank? What are the assets of a bank? It's financial assets, right? Loans, which should be easier to price than some, factory that makes something. And what else is true about bank accounting that's been true, well before 2008? It's a one segment where mark to market has been the rule all the way through. So book value of equity for a bank first is because of the regulatory capital restrictions, you can't mess with it. Traditional companies, you can make your book value of equity go negative. Home Depot spent 3 years with negative book equity while its market cap kept rising because it bought back a lot of stock. Banks can't do that. Second, because it's financial assets, you should be able to put a number on it better, and it's mark to market. So price to book makes sense, and I'm the analyst now. And here again, I'm going to fall back on a very simple. So I came up with a new multiple, but I still use the same way to pick cheap stocks. I go pick, Bayerische, Hypo. I can't even read the German there. Let's go to Commerzbank. Why? Because they have low price to book ratios. In fact, you could argue, and people argue, that if a stock trades at less than book value, it has to be cheap. What's the implicit assumption about book value that leads people to that conclusion? Anybody? When you say a stock that trades at below book value, it must be cheap. What are you implicitly assuming about book value? What's the story that they're saying? The book value can be. You can try.
But I was gonna say that it's not a distressed company.
But you could liquidate it. The assumption is book value is what you will get if you liquidate the company. That's implicit a lot of thinking of old-time value investors. That book. And that might have been true at some point in time when you had lots of physical assets you could sell. But what exactly would I get if I liquidated Weight Watchers? Weight Watchers on the verge of distress, right? What am I going to sell? What would I get if I liquidated Meta or Apple? I mean, these are not companies with physical assets. Book value is kind of meaningless from that perspective. Yeah. That's a good point, right? So in 2008, why weren't we able to sell at market value? Because the market value itself is a shifting number, right? Market value last Wednesday that I marked to market would be very different than the mark to market I got yesterday. It's like trying to catch a falling knife. So you might have started, but okay, that's cheap. I can liquidate. You go out, try to liquidate in a falling market, everything is falling with you. But this is price to book. And remember, the companion variable for price to book is return equity. There's the return equity. Do you see a pattern here? The banks at the lowest price to book for the most part have the lowest returns in equity. Banks that trade at the highest price to book have the highest return equity. Until 2008, I used to stop there with banks. I would stop with the return equity saying, risk at a bank, how different can it be? The regulators will keep you from becoming a risky bank. Those days are done. So I've added a third column with a measure of risk. And in hindsight, I wish I'd used a different measure. I'm going to ask you what that measure might have been. I looked at the standard deviation equity as a rough measure of risk. So before we even dig deeper here, what's the perfect combination you'd like to find as an investor? You want low price to book bank.
On a low price to book bank, you'd want a really high return equity and low standard deviation.
Everybody agree with that? Low price to book, high return equity, low standard deviation. Now, if we're eyeballing this data, is there a way I could convert this rule into practice? See this median number that I've computed? What's the definition of a median? Half of all companies have numbers higher than this, and half of all, on each of those variables. What if I went looking for stocks that have a price to book ratio lower than the median? So I'm not making up a number, some arbitrary number lower than the median, have returns on equity higher than the median, and standard deviations lower than the median. So let's see if there's any, so basically looking for price to book ratios lower than the median, right? So everything below 2.07. So it's all the way through Societe Generale. With returns on equity higher than the median is 11.82. Oh, there's one there. Oh, I'm close, right? Bank Paribas is lower than the median, high. But then you look at the standard deviation, it's 21.93. Standard deviation is higher. So I got so close. I got 2 out of 3. Why should that surprise you? You're not going to get slam dunks in this, but you're trying. You're trying to see if you can get that all 3 X's, right? Low price to book higher. 2 years ago, when Silicon Valley Bank melted down, I looked at the 50 largest US banks and I went through this process. Looked at price to book, looked at return equity, and I actually color coded the number. So if the number was lower than the median, I put price to book, I made it green. If the return equity was higher than the median, I made it green. And for the risk, instead of using the standard deviation in stock prices, I used a measure of risk that I think is more native to banking, a number you tend to think about when you think about a risky bank. What is it that makes a bank risky? You could, but it's messy, right? Because that's going to be really messy because it depends on who you're lending to. And but when you say risky bank, what is it? Lisa, you want to try? You could try that as well. But again, is short better than long? I'm not sure again, right? Because if you mismatch, you could look for mismatches. You could look at default risk, but again, I want something. When people talk about a bank being risky, what do they use? Regulatory capital ratios. An undercapitalized bank is viewed as riskier than an overcapitalized bank. So I brought in tier 1 capital ratios. So here's the mismatch I'm looking for. I want a low price to book, I want a high return equity, and I want a regulatory capital ratio that's much better than expected, right? Higher than the average. There wasn't a single one of the 50 banks that met all three criteria. The bank that got closest was Citi. I'll tell you the two measures where they came in well. They had among the lowest price to book ratios. They traded 0.7 times book value. That was good. Their return on equity was actually not bad. It was mildly, I'm sorry, their tier one capital ratio was really good. So their return on equity, though, was 9.7%, which was lower than the median by about 1%. So it got really close. Take a bank like JP Morgan, trades well above price to book. So it's a red. Has a return equity above, that's green. And its capital ratio is pretty good. You're looking for 3 out of 3. There wasn't a single bank that came in. Yeah.
Even if you don't hit 3 out of 3, I mean, is there still value if you have 2 out of 3?
There's a better way to do this, right? Because this is the problem. Looking for those checks, you're going to very quickly run in. So finally, I said, hey, finding all three is going to be impossible to do. So I'm going to fall back on an old trick. Run the regression of price to book against return equity and standard deviation. Again, let's measure the regression. R squared of 79%. That looks pretty good to me. I can live with that. Are the signs on the coefficients the right ones? Higher return equity companies have higher price to book. Yes, that makes sense. Higher risk companies have lower price to book. Again, okay. Do the T statistics meet my requirements? Yes, they're both above 2. That price to book ratio regression can be used to get a predicted price to book ratio for every bank on that sample. Now I don't have to worry about 2 out of 3. The numbers take care of it. And that's again the advantage of a regression. Because when we do the median thing, we're eyeballing. That's basically, we're trying to find a cheap stock by just looking at the number. And the human mind can't deal with all of that data. So we use the median to make that judgment. In fact, I use this regression to get predicted price to book ratios. So if you take Bayer-Rishi hypo, its price to book is 0.8, but after I factor in the low return equity, its predicted price to book is 0.89. It is undervalued by about 10.6%. So with each bank, I come up with a predicted price to book ratio based on the banking regression and its variables. When you run this regression, though, assuming you get to a sample of 25 or 30, couple of notes of caution. In this case, when I looked at the coefficients, do they have the right sign? They did, right? Is that always going to happen? No. You might run a regression where return on equity not only is the wrong sign, but it's statistically significant. See, that doesn't make sense. Here's what you cannot do. You can't take your pencil and draw a line through the line and say, now everything looks okay. It looks like a plus. The data is the data. And pricing, you've already entered this arena and saying, I am going to let the markets tell me how much to pay. That's a whole pricing game, right? And if the market is doing something senseless, guess what? You got to build that senseless thing into your pricing and saying, that doesn't make sense, but I am in the pricing arena, not in intrinsic valuation. Could you run a regression and nothing is significant? Yes. It's not your fault. The reason I'm trying to preempt the set of emails I'm going to get in the last 2 weeks from you is I've run a regression, nothing works. What can make it work? The answer is the data is the data. You can expand your sample, try to bring in another variable. At the end of the process, you might conclude that I can't explain any of the differences in this multiple across the sector. In which case, you just compare to the average and move on, saying nothing else you could do, nothing for a better prediction. Yeah.
When we look at sectors that are not like the banking sector or oil and gas, where there's a lot of comparable firms, at what point are the comparables that you look at too broad?
But the data, the regression takes care of itself, right? There's nothing, but that's the advantage of the regression. You don't have to draw an arbitrary line. In fact, let's say in the oil and gas sector, right? Is Claire here? No, she's not. As I was going to call. Oh, there you are. Let's take the oil and gas sector. You're sitting in a different row. That's why I didn't catch you. So in the oil and gas sector, what's a multiple you think makes the most sense? I'll let you decide. Enterprise value per barrel of oil, enterprise value to EBITDA, enterprise value to revenue of EBITDA. Yeah. Okay, so you're going to use, let's say we decide to go with the EV to EBITDA multiple. Let's look at the variables you want to control for. Differences in tax rates, probably not an issue because you're probably looking at US. Let's say you're looking, if you're bringing in global oil companies, you probably should control for difference in tax rates. Aramco pays a very different tax rate than ExxonMobil. So, will returns on capital vary across oil companies? They will. And you know what it'll depend on? What the cost of extracting. So if you're in high cost areas to get the oil out, you'll probably earn lower margins and lower returns on capital than an oil company that has lower cost reserves, right? So you probably want to control for that. Will you want to control for differences in reserves across companies? I would expect companies with a lot more undeveloped reserves to trade at a higher multiple than companies without. Capital IQ actually lets you download the reserves and barrels of oil by company. You're essentially going to control for the things you would ask as an individual if you're going to buy an oil company, right? Which is, hey, how much does it cost you to extract the oil? How many barrels of oil do you have in your reserves? And try to bring those into your numbers to make that judgment of, is this company cheap or expensive? The advantage with oil companies, again, is the sample size is so big that you could bring in criteria and still end up with a big enough sample. Software companies, the same way. There are enough entertainment software companies that you can look at just entertainment software companies and get literally hundreds of companies in your sample. And the advantage of having S&P Capital IQ is that, last Friday when I screened for publicly traded companies, because S&P Capital IQ also carries private business data. Why can't we use private business data in pricing?
They're not publicly traded, and you're publicly traded, therefore there's no market pricing mechanism.
Numerator in a multiple is a market price, right? Market cap. So if it's not traded, it shouldn't be in a sample. So first I screened for publicly traded companies. I came up with, I think, 61,000. Then I ran a second screen that I've learned to run before I use Capital IQ. I said, find me all the companies that are publicly traded with a market cap greater than zero. For some reason, there are 12,000 publicly traded companies with a market cap of zero. I don't even know where they trade or what the trading even means. These companies got listed, incorporated, never got traded. I ended up with 49,000 publicly traded companies with a market price. I'm off to the races, right? You tell me what you want to price. I will find a large enough sample for you to do it. In some cases, I can add a lot of criteria and still end up with enough of a sample. In other cases, I might have to be a little looser about and that all presupposes that I want a large sample where I can ask these questions about what do I control. Let's stay on the price to book sample. Because one of the things I do at the start of every year, it's kind of a fun exercise, and you're welcome to try it as well. It takes about 10 minutes to do, is to download the price to book ratios of the 100 largest market cap companies in the US, and you're free to do it 100 largest in whatever country you're in. You can do it globally. I take the price to book ratios and the returns of equity of these companies. And then I do a scatter plot. Remember scatter plots from statistics? There's a scatter plot, and this is in January 2010. So each of these points is a company. The way a scatter plot works is you take each company, you take the combination of price to book and return equity, and you plot them. So if you want, you should count those. There should be 100 bubbles in there. You're saying, what the heck am I going to do with this? If you have a scatter plot, you know what a regression line is, right? It's that best fit line through the scatter plot. That's what a regression line is. How does the computer find that best fit line? Do you remember statistics? How does that best fit line get fit? It is OLS, which is you minimize the square distances from the line. You know how the Greeks came up with regressions? They actually measured each distance. Thank God we're not in those times. Can you imagine sitting there with the ruler saying, let's measure each? But that's basically minimize the square distances. That's why it's called OLS regression. There's the best fit line right there. Okay. You say, what are these two other lines? When you run a regression and you get an R squared that's not 100%, what do you get? You get a range around your prediction. That's a 90% range. What are all these dots that are between the two lines? Those are the companies that I cannot reject the hypothesis that they're close to fairly priced because they fall between. So the only companies I'm focused on, the companies that fall above the line, the top line, and below the bottom line. So help me out here. Which one of these companies is overpriced and which ones are underpriced? Go ahead. The bottom are underpriced. In this case, we'll come back to measure those through. The companies that fall above the top line are overpriced. Let's look at the three that stuck out in 2010. Google, Infosys, and Gilead. You're not familiar with the companies, I'll save you the trouble of what they shared in common. They were high growth companies. And already you can see why the scatter plot might be a little misleading because it compares price to book to return equity, but it doesn't control for differences in growth and risk. And some of the higher growth companies look overpriced, but once you bring in the growth, they come back into line. You look at the three underpriced companies. Does anybody know what COP stands for? It's ConocoPhillips. Okay? XOM is ExxonMobil. So two of your three underpriced are oil companies, and already that should make you a little suspicious. Why did they look underpriced? And the reason was the oil prices had dropped since the most recent year, and they looked underpriced because their trailing 12-month earnings reflected the higher. You see, if you could explain this all away, what's the point of doing it? Hey, these are the 100 largest market cap stocks in the US. You're not going to see any obvious huge mispricing there because it's not like they can be ignored, right? Hundreds of analysts track them. But it's a good starting point for looking for mismatches because one of the first things I did, and don't let this make you dizzy, is, you can do a three-dimensional scatter plot. I hate them because I don't know whether I'm coming or going or where I am in this graph, where I took price to book return equity and expected growth rate. And when I did that, Google, Infosys, and Gilead dropped back to the line because now I brought in growth. If I was worried about risk, I could bring in the regression beta or standard deviation. Again, much of the differences can go away. Your objective is not to explain away the differences, but to see if there's something that still sticks out after you control for the differences. Question? You could, but each one carries its own measures, right? You could do forward earnings that will take care of the ExxonMobil, ConocoPhillips, but then there might be other things you bring in with the forward earnings that create its own noise. So everything's a trade-off. So that's one reason you might use price to forward earnings, is to prevent something like that. So because I had this data, again, I fell back. But now you can see whenever the pictures don't work, I go back to a multiple regression because multiple regression allows me to work through. Across 100 companies, the R squared was 67%. Think about it, 67% of the variation in price to book ratios across 100 largest market cap stocks can be explained by the return equity growth and beta. T statistics, I might as well take beta out. Doesn't really help. So if I'd reran this regression, I'd probably run it with just growth and ROE. And then I can use it to get an expected price for every one of the 100 companies. You can be a one-person hedge fund. Use the regression, you get the most underpriced, the most overpriced, and play it out. If you're a hedge fund, what do? You buy the most underpriced, you sell the most overpriced. Have you made any money yet? You get down on your knees and say, please God, let them move to the regression line. Because if they do, you're going to make money on both sides. You're at a quant investing. Quant investing is just what I did at a very simplistic level, carried to more richer data and more powerful statistical techniques, right? Because this is OLS, simple regression, which is price to book return equity data. But if you think about all of the data we can collect and all of the powerful statistical tools, it's just this carried to the next step saying, hey, that's how we're hoping. But they're all built on that same premise. You're pricing stocks, you're not valuing them, and you're hoping they move back towards that middle that you predict. So here's the update, January 2025. Started this year, I took the 100 largest market cap stocks, put them in there, drew the regression line. Quite a few above that line, right? Let's see if you recognize any of the names there. This Eli Lilly. What made Eli Lilly suddenly surge in price? They among the big pharma companies, they're the ones who are furthest ahead on the obesity drugs. They're the ones that are most likely to displace Novo Nordisk with their drugs. They got priced up, but they're looking expensive. Maybe the growth from the obesity drugs. There's NVIDIA is there somewhere, just barely above the line. There's Palantir. No surprise, most Snowflake. Basically, these are companies where you can say, hey, there's growth there, but it could also be that they're overpriced. In fact, I'll wager if you look at the punishment that's happened this year and you look at the stocks that are above the line, many of them have moved towards the top line, if not into the zone. The only stock that actually came out as underpriced was Oracle. I know somebody's doing Oracle, and it's a bit of a puzzle why they're priced so low, but it's in there. Maybe it's the threat of AI coming for them. It could be any of those dimensions. Looks underpriced. I'm not a pricer. I don't trade things, but to me, this is a good place to start to see if something sticks out, right? So you can do price to book versus return equity. You can add a third dimension if you want. I always prefer to start with the picture before I run the regression because it's better, I think, visually to see where companies fall and then say, can I explain that away? Since we're talking about analysts, I've got fired at multiple places. My final landing spot is I'm now the trucking analyst. Talk about a sector you don't want to become an analyst. The multiple in use is EV to EBITDA. And I'm going to put out a buy recommendation. I'd have made it KLLM, but I'd never heard of the company. I'm too lazy to find them. But I've heard of Ryder Systems, partly because as I've been driving around town, I've been seeing Ryder trucks. Why am I recommending them? Because they trade at a multiple of 2.8 times EBITDA. So I said, buy on Ryder Systems. This is actually an actual buy at the time. I pulled it out and it could be cheap, right? But ask me the questions you would need to ask before you decide that Ryder Systems is cheap. What are some of the things we said we need to control for when you do EV to EBITDA? Yeah. What were their margins like or returns on capital? Because margins, it's not an EV to sales, right? EV to sales, you'd ask margin. EV to EBITDA. Let's start with the tax rate, right? Is there a tax difference here? Maybe all the other companies have NOLs that are carried forward. I checked. There was no real difference. The tax rates seem to be roughly the same. So that's one thing off the table. What's the next one? You're going to ask about returns on capital, right? Maybe, Ryder Systems has terrible returns on capital and everybody else. It turns out this is a terrible sector to begin with. Everybody earns pretty much low substandard returns on capital. So that's not the issue. So that's off the table. What else? Growth. They're all mature businesses, low growth. Check their cost of capital. Maybe half the companies are in emerging markets. No, they're all US companies. I'm almost there, right? The one question that I could not cleanly answer is, this is the trucking business. You know how reinvestment works in this business? You replace your entire fleet every 5, 6, 7 years. Why do you replace your entire fleet? You get much better discount price if you do the whole thing at one go. If I were to add a column to this table, what data item would you like? How old are these fleets, right? I can't tell you years too, because that's a management judgment, but I can tell you how, and that was public data. I pulled up that extra data item, and guess what Ryder Systems had? The oldest fleet or the youngest fleet? They had the oldest fleet. Another reinvestment was just around the corner. You can almost see this play out, right? You go buy Ryder Systems because it looks cheap. A month later, 2 months later, you're going to wake up to a news story. You know what the news story is going to say? They've had to issue $1 billion or $2 billion in debt or equity to buy new trucks, and there goes your cheap EV to EBITDA overnight. My problem, as I said, with pricing is not that people do it, but the equity research analysts would put the buy and Ryder Systems hadn't bothered to even check the data item and ask, could that be the reason? They just went low EV to EBITDA. Just basic questioning would have brought out, hey, this is the oldest fleet. If you factor it in and say, in spite of it, I think it's cheap, then I'm okay with it. But you need to ask and answer that question.
You said the oldest fleet, and that news story happens in 2 months, then all of a sudden you can receive reward.
What's the reward going to be, though? Your price is not going to go up. It's new equity issue. You're going to get diluted like crazy. Your stock price is actually going to go down. Your EV to EBITDA would recover, right? Because your numerator gets larger. But you, as a stock investor, don't get any benefits from doing that. You actually end up with a lower equity value. So from a perspective of an investor, the EV to EBITDA recovering doesn't help you because it's not your multiple that's going up. It's basically the dilution effect that's kicking in. So it's basically asking that question. So let's throw a few. Let's suppose you're comparing, let's say airlines, right? It's a mess. First, what multiple are you going to use? Enterprise value or equity value? Remember the equity multiples, you need equity earnings. So if you have a business where a lot of companies lose money, you probably want to steer away from equity multiples. So you're going to go with enterprise value multiples. And the question is enterprise value to sales, enterprise value to EBITDA, enterprise value to EBIT. What do you think? Or maybe passengers flown, right? I mean, in a sense, open the door. There are lots of different variants you might decide to use here. And to control for across airlines, what are some of the things you want to control for? What do you collect? The rates at which you fill up your flights might be a factor. How old your aircraft are might be a factor because you might have to replace them. Tax rates, if you're comparing US airlines, but if you're comparing airlines across the world, you compare for differences in tax rates. Be creative, right? When you think about risk, your risk measure doesn't have to be a beta or something that came out of intrinsic value. It can be something very specific to pricing in the sector you're looking at. Okay. Do one final example and we'll end for the day. The only business that's even more boring than the trucking business is the grocery business. For a long time, the business when nothing happened. Margins were low, growth rates were low. You're comparing, company after company, all at the same. Until in 2007, there was a new kid in town that kind of broke the mold. And grocery analysts didn't know what to do with this new company called Whole Foods, right? Grocery business with higher margins going after, at that time at least, a niche market. And when Whole Foods came out in 2007, I did basically I did a scatter plot of grocery stores and I threw Whole Foods in and you can see the outlier right there. It looks hopelessly overpriced. People are still putting buy recommendations on it. Why? They said the margins are higher, which was technically true. At that time, when I ran the regression, though, even with the higher margins, my predicted price to sales ratio was 0.43. It was trading at 1.41 times revenues. Looks dramatically overpriced. That was 2007. This is 2009, 2 years later. Same sector. See where Whole Foods is? It's gone from being up above there to almost the most underpriced company in the sector. So it went from hugely overpriced to hugely underpriced. I did a predicted price to sales, 0.36, was trading at 0.31. It went from being very expensive to one of the cheapest grocery stocks. Just 2010. It's tough to find it, but Whole Foods now falls right on the line somewhere, right? Or just above the line. So it's gone from being underpriced to again overpriced. There's a story here. Because by 2011, Whole Foods was on the line. For 4 years, Whole Foods went from being overpriced to underpriced to overpriced because analysts didn't quite have a handle on it. And once they figured it out, Whole Foods settled in. But it took 4 years for the market to figure it out. You come to 2015, there's Sprouts. The line should go up there. Again, a company that analysts couldn't quite figure out. A small, growing grocery store chain. The point I'm trying to make is when you get a new company in a sector that doesn't look like any of the existing companies, it takes a while for analysts to figure out even what to do with it. And that's your chance in intrinsic value. That's when markets make mistakes. Yeah. The analyst is every grocery store you trade 0.3, 0.4 times revenue. See, they're all low margin businesses. When you get a company that has a high margin, you've never seen anything like this in the grocery business. They don't even have the, because they don't run regressions, right? The way you do this, you compare EV to sales across companies, and what do I do about this company that doesn't look like any of my other companies? Did analysts, when Tesla came in, that's exactly the problem they ran into, right? They've never seen something like this in the automobile company. 15 years later, they still struggle with Tesla because it doesn't look like a legacy auto company. Sometimes when you get a new company in a business that kind of disrupts the Airbnb in the hospitality business, nobody has any idea how to price the company relative to other hotels. They don't even know what to price it against. Right? So it takes a while for investors to learn about a company, especially if it's very different from the traditional companies in a business. And that's your chance and my chance as investors. Yes. It's now back down. So basically, you can see that was 2015. You look at Sprouts in 2025, people have kind of soured on Sprouts. It's come back to the line. So eventually, they work their way back to the process because, it's Sprouts when it came out, it had regional issues because it wasn't a national chain. It had these growth issues and margin factors, things that made it very different from a traditional grocery business. Right? And you're going to see that play out. So I'm going to, if you want to start your pricing, you have everything you need to start your pricing. So at least, how many of you have not used S&P Capital IQ yet in this class? You're not going to admit to it, even if you haven't? You should though, because for the pricing part, it'll help you a great deal. You can live without it, but it'll make your life a lot easier if you can use it for the pricing.